So covered the disclosure notes for compliance. Let's get into it. So the world changed once again last week. We shifted from proxy wars in the Middle East to a direct war with the Iranian attack on Israel, which was well defensed, but still changed the calculus for investors. And it comes at a time that central banks were already fighting a battle against inflation. And that took a little bit of a surprising turn last week. We had trade wars going on, the battle for tech supremacy and world domination. It's like a James Bond film right now, what's going on around the world. Today, I just want to talk about the events that happened prior to this weekend's attack, what was going on in the markets, what I think is the impact there, review the current economic backdrop, and then discuss where we're seeing opportunities today, because I think you can be positioned to not overreact to what's going on and still benefit from the dynamics in the global economy. So it was a pretty amazing week last week. It started off with a downturn in the U.S. equity markets because of concerns about potential retaliation from Iran because of the killing of some of their people by Israel. Then we started to have oil prices rise, the commodity prices rising as a result. And then the CPI number comes out running hotter than people thought, and it's 3 months in a row. The idea with the Fed is usually, 1 or 2 months they're not going to overreact to, but 3 months becomes a trend. And they were starting to hear from the central bankers that maybe they're not going to do as much, which rattled the stock markets more, which was fine because we're due for a pullback or at least a consolidation in the stock market after the pretty strong move we've had for some time, certainly for the start of this year. And then yields were rising while the market's pulling back. And then we have another announcement on PPI, which eased some of the concerns. We rallied back, and then you started to see treasuries, though, throughout this whole time moving up because we had a failed auction or not a great auction on the 3 years last week. And one of the concerns that's been on Wall Street's mind is who's going to buy the bonds particularly because some of the geopolitical dynamics that are going on. And then lo and behold, we had the concerns going into the weekend. We had a sell-off. You had yields rising, and then we know what happened over the weekend. So you can see the issues around CPI pretty clear. We're running a little hotter at 3.9 than we thought. This is brought into question, will the Fed ever get to the 2%? I think we overreact too much to these 3-month trends. I think the idea is that you are seeing inflation trending down. I think the bigger problem is cost of living, and I think there's an interesting dynamic that's going on in the economy that's really a bifurcation of the economy where you have consumers on the high end doing extremely well and everyone else spending every nickel they have just to pay their bills and keep up. So it's a very bifurcated system, which is going to create some real problems for the Fed as to who are they trying to help and how are they helping them when they go through this. So you can see the Treasury yield curve is clearly going the wrong way. So the way to read this is yellow is a year ago, red is a month ago, blue is a week ago. And this is as of last Friday. And as you can see, we've had a very significant move up in rates. And this is what the market's been struggling to digest. And you are seeing what we think is going to be really this higher for longer, or I changed it to high for longer back last fall. But because I thought we were going to be stuck at a level that was much higher than the market thought, and we're there now. So I think we're in a mode now. It's moved up again. Since then, we're in about 4.67 on the 10-year right now. So still more pressure on rates. I think who's going to buy the bonds is a big issue, and I think that's going to be one of the things that we're going to have to keep an eye on, because you're also seeing policies diverge where the Fed's going to hold rates a little bit longer than the ECB, which is going to strengthen the dollar, put more pressure on other currencies, which may make buying treasuries a little bit harder. So I think the whole dynamic about safe haven trades is one that we have to think about a little differently now than we did even a couple of years ago because of the geopolitical mess. China's not going to be rushing to buy treasuries right now. So we'll come back to that in a minute. PPI did help calm the markets, and you can see this is one thing that is trending the right way, but it's not really the cure-all for the Fed's concerns about inflation, but it is a sign that you have to be careful not overanalyzing any one number. Consumers have reacted a little bit differently to the numbers. Consumer sentiment has been rising for most of the year, and then it started hooking back down. You are seeing some layoff announcements of size, like Tesla, 14,000 people. You have some other people announcing layoffs. But inflation expectations have ticked down a little bit for consumers 1 year ahead, but they're still running below 3%, but still higher than the Fed would like it to be. The concern about this is if consumers start changing their behavior, then corporations will react because consumers start slowing down their spending, corporations start pulling in, laying off people, and you get this negative cycle. And that's one of the fears that is what happened in 73, that you get this reinflation going on before the fight's done, and you end up having a setback. And I think that's one of the things the Fed's been very concerned about, of not being too quick to stimulate by cutting rates. So I think this is going to be one of the challenges we see going forward. But through all this, the S&P continues to flirt with new highs and push up to new highs. We're seeing this as a sign of the relative strength of the businesses and also just of the general economy. And I think this is one of the challenges that's going on for the Fed. It would be much easier if the economy was weak for them to decide to cut rates. But when you have the economic strength that we have, I think that's really creating a real dilemma. And it's also creating some confusion for the market. You've had gold rallying up quite a bit too, and this is one safe haven trade that continues to work. China has bought 15 months in a row. Their central bank has been buying gold. I think that's in lieu of treasuries, and I think they're doing that with a view towards future sanctions and the like. But Costco's running $200 million a month in gold and silver sales from their stores, which is absolutely crazy. So it just speaks to how people are feeling about the economy. And you do see in signs of stress, safe haven coming back, and gold is one. It was interesting that Mariana was talking about creating a digital gold because it is really one of the things that, as store of value throughout, has really held up. And I would just say on gold, if you go back and look at a chart of gold back to 2000 and its performance against other asset classes, it's actually performed in line or outperformed the S&P throughout that whole time. Crude's really the big issue, and this is one of the big concerns. That, Brent was back over 90. I think we talked about when the conflict first broke out in October, we said there were a couple different scenarios, Mark, and it's been contained so far, but what happened over the weekend changed that. And I think we have to see if the Israeli response is targeted and somewhat not too violent to say. It's hard to say that with the response, but that it just says we're done now and they're both going to dial it down. I think that's would be helpful, but this is really creating a mess. The other Middle East nations being choosing sides is going to be something. And to add to this mess, you now have a whole different issue, which is the way the fight in Ukraine is going on, where Ukraine's drones are going after Russian oil assets. So we could see the oil prices continue to push up. And what do the Saudis do? What does OPEC Plus do is really going to be a big issue here. So a lot of the inflationary pressures are going to be around this. And the concern is, do we see a spike back up to, the 120s like we saw in '02? And that puts some real strain on the global system that, even though it doesn't stay long, creates challenges that will wreak some havoc on the markets. So with all this going on, now the streets has to adjust their expectations. So this is a chart pre the CPI of what they would do for the first cut, and this is the top chart, and the number of cuts is the bottom, and then the far right is what their current views were as of last week, prior to right after the CPI. So you can see a lot of cuts in June, now down a lot, and everything's being pushed out to July and September. I think there's a good chance the Fed's still going to move in June or July. I think there's concerns about both sides of the economy that would have them feel that it's okay, but it wouldn't be a surprise to see them push it out to June or July before they actually make the first move. But the other issue is the number of cuts, and how that's changed is actually pretty interesting as well, coming down from significantly higher numbers to much fewer numbers. And remember, at the beginning of the year, they were talking about 7 cuts. So the number of cuts is actually continues to come down. I think 2 to 3 is probably going to be, all things being equal, where they end now. And this just shows you how much it's changed for the different Wall Street. And it just speaks to, when you take what Wall Street's saying, take it with a grain of salt, because they redo forecasts frequently, and you can be right enough if you change it frequently. So I think but the changes are pretty dramatic. And I think that's one of the interesting things is when you see where they were in a 1 week period, 50 basis point changes or more was actually pretty telling to me of how aggressive the street was, and also how the street really trades very similar fashion. So being away from them is a good idea. To be able to move away from the market is probably a good idea. So talking about that, I want to shift gears to where do you find opportunity now? And there's a lot of discussion about relative valuations around the world. And I saw this chart and I thought it was really interesting. So the left side is the CACs, FTSE and DAX with their combined market cap valuations. And on the right side, you can see several of the large US tech stocks, in many cases, all being larger than the entire market capitalization of these stock markets. So that's interesting. It just gives you a sense of the size and difference of perspective. But this chart also speaks to the relative undervaluation of some of the foreign markets against the US, because when you look at the size of these companies and their multiples, and then you look at the European market and look at their multiples, it's easy to see where some of that valuation gap stems from. And I'm not knocking Europe. There's a lot of good opportunities to invest there now. But one of the interesting dynamics that's going on, and I've talked about this, is the European Roundtable last summer. I was saying consumer confidence, business owner confidence, where they're going to make their next investments, where they're going to set up new plants, was going to not be in Europe. It was going to be in the US. And now you're starting to see companies like Shell talking about moving their listing from Europe to the US. And part of that is to get better valuations on their companies. We own another aggregates company in our portfolio that's doing the same thing. It's a British-based company moving to the US. It's in one of the hottest areas where multiples are in the US. And I think it's selling for probably where MLM or Martin Marietta or those guys are selling around a 21 multiple. This would be selling for a 13, and their view is move to the US and get their revaluation. So interesting dynamics going on there, and watch how you see companies relist and shift their listings around to try and close valuation gaps, which is a different approach than they've taken for some time. So where are we seeing the opportunities? And just for a little background, ARS has always seen the world through a different lens, and we end up with very different looking portfolios. And to put it in perspective, last year we were underweight. All the FANGs except Microsoft. We cut NVIDIA in March of last year, right before OpenAI made their announcement. We cut the position in half. And as the year ended, we were 20 basis points behind the S&P. And we were really well underweight the FANGs. And to do that was pretty interesting. So we had to get there by owning things that others weren't owning. This year, we're outperforming the market through yesterday by about 4.5% in our core strategy, our flagship strategy. So I'm giving you that background, not to brag, because performance is fleeting in the world we live in, but to talk about how did we get there. And we got there by really overweighting areas that the market was not recognizing well. And for us, that was the energy sector, the materials sector, and the industrials. We're well weighted in the chips, we're well weighted in the cloud and AI, but really by going to areas that the market was missing, we thought you could see some big opportunity. And this is what's driving our outperformance this year. And you think about what's going on geopolitically, whether it's China, the Middle East, or Europe, these are the areas that are going to be getting the most attention from governments in the West to protect their systems in their countries. And they're not well represented in most institutional portfolios. So if you just think about the materials sector and how essential that is to national security, to advanced technology, to running the grid, to everything we do, and yet it's only 2.35% of most people's portfolios. And you go to the industrials and you look at the weightings there, and defense is only aerospace and defense is only 2.7, 2.8% of the weightings of the S&P. So you're not getting the exposures in the areas that are most really at the forefront of what's going on today with the weightings. So the blue is the S&P weightings, the orange is the ARS weightings in the portfolios, and we are taking a very aggressive view because we see where the world is positioned. And I think what we're seeing in the public markets is a lot of the areas that the private markets are seeing the best opportunity in as well. But in the public markets, because of the way the S&P is constructed, most portfolios are not getting the exposures they need. And to take it a step further, it doesn't take much to move the needle. So this is a different look at Apple and Microsoft against the top 5 defense companies in the US. Their combined market cap weighting is under $500 billion as of the 12th. You take the top 5 E&P companies in the US under just over 400 billion, and you take the top 5 steel companies and under 100 billion. So if institutions start moving in the same theory that is applied to Bitcoin and institutions moving into Bitcoin, if you looked at these areas, and it's hard to argue that these areas, given the dynamics today, are not going to attract significant capital, whether it's through the fiscal policy that's been put out or not. This is actually a really interesting concept of how capital is misallocated and where you can see inefficiencies in what is viewed as a highly efficient market. So I think this, we're still believing that the 3 biggest forces around today, and this is driving not just markets, but politics, is the rising living costs. And the governments have not figured out how to communicate to the populations that way, which is going to get a lot of incumbents thrown out around the world. I think you're seeing this continued geopolitical fragmentation that is getting worse, and the lines are being drawn in a much clearer now of the adversaries that are being created here. And it's really going to be interesting to see how the Middle East plays out, because they're being forced to take sides, and it's going to be that's a very interesting dynamic to see play out. But this is bleeding into the reindustrialization and really getting to the industrial policies of nations. And it's putting some countries in a real box. How do you play both sides against the middle? When you want to be in the US market, you want to be in the Chinese market because of the size. But how do you do that and still navigate, particularly as governments are setting up rules to make it virtually impossible to do business that way? So do we end up with a truly bifurcated global system that has full redundancies? And what does that do to the inflationary pressures? I think that's real. I think you now have these 3 new forces that are driving capital flows, which is generative AI, obviously, the GLP-1 medicines, and the climate transformation challenges that are taking longer to get there, and how interrelated these areas are becoming, particularly generative AI and climate and energy needs, I think is a big one. But I think we're now back into a mode with the inflation expectations, with where rates are, and with the pressures on the global system, that it's going to be about earnings rather than multiple expansion going forward. I don't think you're going to see what the market was hoping for at the beginning of the year of the massive rate cuts. So this puts us in a mode now where it's going to be company by company, whether in the public markets, the private markets, and whether you're in, and that is the same for equities or fixed income. And I think the credit markets are one that we're going to have to be really careful of which companies are going to be able to handle the increase in rates or the higher rates and their increased interest costs. The world is still favoring the U.S. In terms of where capital is flowing. I do think there are pockets of opportunity, and China just put out a 5.3% GDP number. I would look at that with the same skeptical eye you would typically look at a number, because they were front loaded in the first part of the quarter. Their March number was not that great, and their retail sales and other things have been dropping. So still some challenges there, and there's some real issues, but I do think there are still opportunities to be found around. It is active over passive. I would say growth over value, but I would be shifting a little bit more to growth at a reasonable price rather than stretching for growth. Those high multiples will not do well in a higher rate environment. And this is really one where strong balance sheets are going to matter in cash flow. One of the ironies of the FANGs, though, and this is part of what's helped them hold up across the board, not the individual like Tesla and the others, is that they are really both offensive and defensive in that obviously they have the higher growth rates, but they're defensive because their balance sheets and their free cash flows allow them to handle the environment much better than others without the massive layoffs. If they do or have layoffs coming on, it can be because they are exiting businesses that weren't really creating value for them. So they get the best of both worlds in a sense right now. But they do have their own challenges, whether it's antitrust or other. But I think they're going to hold up a little bit better. But we do see opportunities, and you're going to talk about opportunities in Africa later this week. And we talked a little about China last week. I would just say we can be constructive. The numbers show when you have the kind of returns that we've had for the first part of this year, that the year should continue to be quite strong. Election year numbers tend to be quite strong as well. So I think we're in a mode where it's going to be bouncy, and we're going to see how we get through this. I think the big question is how far does it escalate up in the Middle East? And depending on that, all bets are off. So at that point, we get Hamlet in, and he can talk about where we see things going. So I'll stop there, Mark, and open up for discussion.
Thank you again, Stephen. Questions, comments?
Yeah, I have one question. You're saying that multiples much higher in the US versus Europe. Does the dual listing does the job, or you have to delist in one place and relist in the US?
I think they're going to opt for for delisting. I think they're going to make the move.
Okay.
But it really depends on the company and the industry too, of what the relative multiples are in the US versus the European multiple for that industry. Like in the energy space, I'm not sure what Shell's selling for, but a lot of our energy companies sell for relatively low multiples. So it just depends on the area.
Mm-hmm.
Other questions, comments?
Well, if you don't have questions, I'll open up one for you guys. There was a report put out, the IMF's putting out their World Economic Outlook update for April today. They're also releasing their outlook for their global risk outlook as well. Last week, they released a chapter on private credit, which everyone's looking at right now. I shared it with a couple of people in the group. I can try and see if we can put in the chat, Mark, here if I can find it. But it was actually quite interesting about some of the risks and challenges with it that they see on a macro level from it. So I thought if you're investing in that area, it's worth taking a look at. I know, Bill, you looked at it and you're in the space, so you're better able to comment on than I would. So you want to share your thoughts on it, might be helpful. That's an area that people are heavily investing in now. Bill, hi. Or is Eddie on? Eddie read it as well.
I received it. I did not read it.
Yeah, I got that from the notes back. Well, we'll put it in the chat if we can find it, and
I'll try to. Yes. Yeah. Other questions, comments?
Hey, Stephen, it's Joe Azzaro. How are you?
Good, Joe. How are you?
I'm good.
Where is Joe? Joe, are you on video? Are you on video somewhere?
I'm not on video. I'm just walking outside, so I can put it on. But
Okay.
Sorry. There you are, guys. Nice to see you. I saw, Mark, you've got multiple screens of view, so it was nice to see you a couple times today from different angles.
Appreciate it. If you came here, you'd have the same experience.
Well, I'll add it. Yeah, maybe next week or the week after. I'm back in New York, so I'll put it on the list. I'd love to see you guys.
Yeah.
Stephen, when it comes to gold, there's kind of a divergence with what's happening within the treasury market and yields as well, right? I mean, do you see like macroeconomically, do you think that there's like signals that we're moving, towards gold and away from the dollar? You think there's like a fear issue? What do you think is really driving that? And like macroeconomically, do you see any big risks as to why people would be moving towards a safe haven asset like that?
I think the central banks are buying gold because they're concerned about sanctions. That's what China's doing. They're putting they're sanction proofing their reserves. When they had them, they had I think $1.2 trillion of treasuries. I think they're down now to about $800 billion of treasuries. I would suspect they're not going to sell too much more, but they could sell that down a little bit. I think their view is they'll take the 5% that they're getting on their treasury yields right now and keep that part of the portfolio, but they wanted to risk-proof against sanctions if they attack Taiwan, or if they just get sanctions against them for helping Iran or Russia out. So I think that's one of the issues. But I think you are seeing consumers buying around the world as well, for a variety of reasons. It could be because their own countries' currencies are being devalued pretty aggressively, which you are seeing in a lot of countries, or it could be just because they've always had gold viewed as a safe haven in their nation. I think the Costco sales are interesting in that speaks to a different behavioral mindset of consumers worrying about the world. So I think that's more of just general geopolitical worries driving that as well. I don't think there's a move away from the dollar, though, in a meaningful way that can be done.
And what about the China-Taiwan situation? What kind of probability do you assign something like that happening? And obviously, if they're kind of already positioning their chips in a way to protect themselves from sanctions, I imagine that's somewhat of a higher outcome. And I would almost imagine they would probably do that before election, or what are your thoughts? Do you have any kind of idea on that?
I don't know that China's gonna. I don't know that China's gonna rush to do anything now with all the other stuff going on around the world. Although it's a good cover if they were going to, but I'm not sure they're ready economically or militarily to do anything. If they were going to do it, they could probably do a blockade and do a lot of what they want to do. I think an attack would destroy a lot of the facilities they need. So I'm not sure they get what they're looking for that way. So I think they're going to wait and let things play out a little bit more.
All right, thank you.
But
they'll probably attack them tomorrow.
last time Stephen did this, he was Russia will never invade, and I think it was within 5 days.
It was one of the scenarios.
Yeah.
Michael Daly.
Yeah, Michael Daly.
Hey, Stephen, thank you. Always enjoy our Tuesday morning. I heard the expression digital gold, and my investing in gold was in the physical asset. Can you comment on how does digital gold provide the same security against, the same safe haven? It seems an oxymoron to me.
I didn't say it would provide the same safe haven. I just said that Mariana had mentioned they were talking about that at a luncheon they had in Europe. So no, I'm not a promoter of digital gold. I'm just saying that was the discussion that came out recently at the luncheon they had in Europe, in London.
Thank you. Thank you.
Other comments, questions?
Sure, I'll jump in. When you were talking about rates and rate cuts and whatnot, rates are high, but they're not crazy high like they were in the early 80s. And I think the Fed has done a pretty good job of threading the needle, if you will. So I'm just not as concerned because it's sudden rate hikes and things like that concern me. Not if rates are stable. At least looking forward, it allows you to make decisions.
Okay. I agree with that. I think the problem, I agree with all you said, the rates are not historically high. The problem is that people's mindsets adjusting to the change, it takes a lot longer to make than the actual effect of what the world they're facing is. I think that Wall Street has been very eager to see rates come back down, but they're not going to get what they're asking for from the Fed. And the Fed can't do it. It's not that I think what people are missing is they're saying the Fed, but the issues that are creating inflation right now are not things that Fed raising or lowering rates would adjust. It's the $4 trillion of fiscal stimulus that was put into the system after the Fed was done with their quantitative easing that actually really has created the last leg up of inflation, as well as the two conflicts that we have going on. So it's very difficult for the Fed to do anything to address what's going on when inflation is trending down and is on a glide path that has been from 10% down to 3% is pretty good work. But now it's the last part of it that's going to take longer, and I think that's just going to require some patience. And you'll have fits and starts along the way. You always do.
Walter?
Yeah, Stephen, thanks for your presentation today. Quick question around inflationary pressures again. A lot of what we see is really geopolitical, the positioning of oil and food prices, et cetera. But I see that, a lot of what's going on in this country is also self-made in the sense of we're bringing back manufacturing to the US. And that has all sorts of implications of its own. Labor costs, raw material costs, Buy America is great. It's great for jobs, but that has its costs. So what do you think the implications are, or how do you balance that in terms of what's actually causing inflation?
Well, I would say that, first of all, China's wages have come up a lot since they had the huge advantage. They were trying to raise wages 10% a year for 20 years. So they lost some of their competitive advantage. So when you're bringing stuff back, it wasn't like it was 20 years ago in terms of the cost differential, but it's still big. I think the issue, and then you can go to other countries where they have, such as Vietnam and others that in Southeast Asia that have done well to pick up the mantle and lower the labor costs again. I think the real issue of returning manufacturing back to the US is twofold. One of them is inflationary, that's national security. I think the second one is the belief that productivity can offset some of the costs so you can do more with less. And the newly designed factories of the future would allow you to be as competitive as you were before we sent all those jobs away. It just won't bring back as many jobs as were lost. I think it just secures the system better is how they're looking at it. Other people can disagree and say that that's all BS, but I think that's really the way that a lot of people are thinking about it, and the way the government thought about it was really more as much of a national security angle in it as anything else. As a starting point, with productivity is the other element of it, that we can be more productive and offset the cost differentials.
So, Alan, I saw you had your hand up for a second. Do you have a question?
Yeah, I mean, I just want to add,
Do you mind
you summed
introducing?
it up very well.
Do you mind introducing yourself?
Yeah, sure. Alan Alden. I've been most recently working with the Gunn family in Palo Alto, Merchant Venture. It was the firm. But one of the comments I was going to make is, I mean, for years, and I think that the hidden component of inflation suppression was China. I mean, they assumed really a lot of the cost pressures, and we have been relying upon that for 20 years. And it's a deal with the devil or whatever you want to call it, but we've become very dependent upon that. And China has been able to rise significantly with its presence in the world because of that. I think the real question is we're going into an election season where, Biden has been very aggressive with with the tariffs, especially in technology, and looking at increasing those further. And on the other end, you've got Trump talking about increasing tariffs up to 100% in a certain case. which, if you think about it, is really going to be a tax on, his voter base. It's lower and mid-income people, because you look what goes into a Walmart. What percentage comes from China? What percentage from IKEA comes from China? It's a very large portion. And just to say we're going to move that into, other areas of Southeast Asia or Mexico, it comes at a huge cost. And we're discovering that today. And that is where the inflationary pressures are coming. It's a geopolitical, we can of course circumvent China, but again, it comes at a cost. And one other comment I was just going to make is they mentioned about the digitization of gold. I've done a lot of work around Africa and emerging markets over there, and you're seeing a lot of payment rails being built up right now for crypto, because a payment, a business-to-business payment will take anywhere from 3 to 5 days for that settling. And so they are looking at using stable coins, be it, there's two different choices you really have: is a dollar-denominated stable coin or some government-based monetary stable coin. The other side would be an asset backed. And the reason that somebody would like the digitization of gold is the BRICS countries want to get away from the USD, and this provides them a non-government way of having a way that they could use, a currency, and it would be backed by gold, an asset that actually Africa has some control over with the way that they do their mining. It's definitely less than it was, but those transfers of across the monetary system, instead of taking 3 to 5 days, literally take minutes. And so that is the benefit for that in Africa. And the second, thing I would say is, especially for the citizens who are encumbered by these governments and whose, their livelihoods resides in these currencies like the Naira, and they're getting devalued on a daily basis. This really democratizes their ability to have savings outside of that local currency. And so that is what's really exciting and interesting from that perspective.
Great. Anyone want to chime in on that one, or have another question or comment? Otherwise, Adam?
Yeah, my question's for Alan and also Stephen regarding that digitization of gold. You still have to value it. What's the benchmark? At the end of the day, the benchmark is the value of gold to the dollar or the euro.
It's gold, but the difference is it's not being valued against a government-backed currency. And there's a couple of things you have to understand about.
It's not controlled.
So hold on. The governments themselves do not want to hold dollars. And if you look at the BRICS countries right now, they're rapidly going away from the dollar. And then what's your choice? A digital yuan, RMB, or so you have that choice. But they want to go, and so the reason I say gold is more interesting is because there is a huge social stigma right now being tied to the U.S. And there is a huge war going on in Africa right now with the hearts and minds between China and the U.S.
Right.
And China has gone in and done all these deals. And there's actually a lot of xenophobia throughout Central Africa of the Chinese. People are upset because their kids are being taught Mandarin. The Chinese have come in there very heavily. They're very indebted now. They're waking up to the fact that Belt and Road has a lot of, it's a huge burden over time. And the Chinese have gotten the rare earth minerals and they've built a couple bridges, but now all of a sudden they're having to pay tolls and things like that to pay for these items. And those are taxes that they did not have before. But again, it separates them away from that government per se and puts it into another type of stored asset value. And that's the difference.
And what would be the standard stablecoin that would be the foundation for that?
For right now, there's two of them out there already. Paxos. I mean, you've got several different gold-backed stablecoins that are out there.
Right.
But what I would expect to see is more a government or several governments, or more importantly, several of the large banks go together and back a coin themselves. And it's right now, JP Morgan is looking at a stable coin. There's different groups that are looking that will back it. The question is how do you pump liquidity into the environment and get that acceptance. And so, I think a good example would be, like Bats Trading back in the day with Dave Cummings. When he wanted a different alternative exchange, he went out and got 10 of Goldman, a bunch of the top traders to go out there and put 10 million each. They got 50 million in. It started some liquidity, but more importantly, it drove those parties who had an ownership stake to drive volumes and liquidity into those exchanges. So I would see Standard Bank, you'd see, ABSA, a bunch of the larger banks, and starting in South Africa and some in Nigeria, perhaps coming together and pushing something like that. You'd have to do, get that. And I would actually even see the government, the governments coming together, because governments are already talking about digital coins in Africa. They want alternatives. But more importantly, I think the people, once they wake up to it, if they can have that stored value outside of their local currency, I mean, that is completely, again, it democratizes them outside of their own government. And because they're being penalized for where they're born. And by being beholden to those governments and the corruption that those, the problem with Africa is it consumes itself. And, you look at South Africa, you look at Nigeria, the two top economies. South Africa's currency has gone from 8 to 19 in the last 10 years. You look at the Naira, it's lost 95% of its value in the last 10 years. And, again, the poor citizens who are born there are subjected to that. And what this does is give a potential avenue for people to have, they don't have access to the stock markets, but what they do have is their digital payments they're already doing. M-Pesa, the biggest digital payment provider in the one that everybody emulates is M-Pesa in Kenya. And 70% of the GDP flows through M-Pesa today.
So
anyway, I'm sorry to take everybody's time.
Thank you, Alan.
I wanted to jump in because I'm thinking along the lines of Adam. So who are you going to trust to hold the gold?
That's why I say if you had a consortium of banks, that's where it gets interesting. And a consortium of governments or banks, but the governments over there, and especially, I'm sure in other emerging markets, do not want to be beholden to the traditional Western powers. And again, you're seeing the BRICS really push away from, especially the US. And I think in many ways it's possible. I think that these, you mentioned the exchanges. There are so many zombie exchanges sitting out there right now, and the JSE is a perfect example. It's by far the largest exchange in Africa. But the number of listings that they're losing every year, it's 20 to 30 that they're losing. I mean, it is a far cry from where it was 20 years ago. And, you've got Singapore, same situation on their exchange, but, that they're losing literally, billions, tens of billions, hundreds of billions of dollars in equity. And because the people are now purchasing, their NVIDIA stock from South Africa. They're getting more access. And, the South Africa just increased their foreign investment holdings from 30 to 45% for retirees. That's a huge opportunity for Western companies to come in there. I went to, the family I was working with, he used to run Dodge & Cox. I was talking to them, you guys should be pushing that, targeting this all day because they want access to the US markets. And so does everybody else.
Other comments, questions?
I would just add, Mark, the Bank of International Settlements was the central banker's bank, has done a series of reports on crypto and digital currencies. And one of their views is over the long term, you'll have a wholesale central bank digital currency that is basically the central banks of the world can all use that. And that becomes basically the reserve currency. And then there's different branches off that can solve different problems. Because I think the idea that a digital currency solves all the problems is part of where people get confused. And then you go for specific use purposes on the different types of structures they'll set up. So you could have one that, to Alan's point, that institutions use for the flow of wholesale funds, and then you have others that run with different kind of structures that are more for retail. So there is a structure that the BIS is testing or talking about
You
now.
can have someone from BIS to come and.
I don't know. I'm not sure who you get there. But they have done a bunch of work on it. I think the New York Fed just released another report on digital central bank digital currencies as well. So there's a lot more talk about that. And once they get the framework for any kind of digital currency, then whether it's gold or crypto, doesn't really matter, I don't think.
Nishant, let's make a note to reach out to our friends at various parts of the central bank.
Patricia might be able to, from her work with Joe,
Okay.
IMF might be able to help.
All right, 5 minutes left. Andrew's got a question. Andrew, you lose your right to. Okay, that's good.
I was no.
By the
I
way,
didn't know if
when
I
you
was
when you
waiting for
didn't when you didn't unmute the other day, you owed us some beers, and I'm not sure we cashed in on that.
I bought you a drink and everyone a beer at ping pong. I'm good.
Yeah.
Anyway, so just a comment and a quick question for Stephen at the end. So the first comment is there are as many US dollars floating around the world as there are in the US. So it's a reserve currency. The latest scare is the Chinese running to gold because Congress is thinking of seizing Russian dollars held at the Fed, which I don't think is actually possible because the two of them are not related. And so that's the latest scare. But the Chinese have been trying for years to get a basket of currencies as opposed to the US dollar. And believe me, they've tried and tried and tried, and it hasn't worked because you have someone's currency. So if you take gold, there are custodians of gold around the world. State Street's gold ETF is backed by physical gold held somewhere. And I think the downside to some digital currencies stable coins or whatever.
I think we lost Andy there.
Whatever they be, is over promising liquidity and eventually sell the gold and give people their value back. But just a quick question for Stephen at the end. Stephen, do you think there's any contribution to inflation by high interest rates? In other words, cost of capital, cost of factoring, cost of borrowing money, is that then become a reinforcement of the inflation rate at all? I'm not sure.
It's an interesting question. I think psychologically it reinforces inflation expectations, which then can create some of the behavior that pushes the pressures up. But I'm not sure is the answer to your question. It's an interesting question. I do think that the unbelievable fiscal spending that we've done over the last couple of years is, and don't get me wrong, it may work, but it may work to increase the productivity as we hope. And we better hope it does, because we just spent $4 trillion to try and get productivity up and to get our national security up. I think that is the issue. If you don't get the productivity, then it's like any other investment that you get no return on. Only this one, you have the negative return because you're still stuck with the higher debt costs that you're probably going to have for the debt you took on to do it. So I think that's really the issue. If we don't get the productivity, we're screwed.
Yeah, certainly the proof of the old argument whether fiscal or monetary spending has effects. Well, fiscal spending, no question, won the war of having inflationary impact.
It is ironic that the QE for most of the time did not create the inflation expectations that people were deathly afraid of up front, which says two things. One is we really didn't understand how QE was going to work as a world to begin with, but it also says that to me that we were in a much worse position than the world actually even understood in 08. And I think the actions really helped save the system. So I think we're in a very interesting dynamic right now as to where we go from here. But I think for right now that I would not move much if I was the central banks, certainly until I get better clarity on where rates are going.